So you buy and forget. But we have learned only 1 out of 1,000 work. Rest of them generate a below market return. So active management is the key now. The learning has been let the algo do the talking. And when it says exit, it sees something which you haven't seen, which is coming also. BSC, example. And just before Jane Street, we had already exited. Had I not taken that, we would have been 10% down now.
Do you have to be very good in maths to do quant?
You need to have your concepts clear. AI can do it for you.
Hey guys, welcome to another episode with me, Shashank Udupa. This is the Connecting the Dots podcast where I get amazing fund managers to give you as much knowledge as possible. So today we have Manish Ahuja from IntelliInvest, who has been in the investment banking journey for the last 20 years. And he has also brought institutional grade research to the retail audience. Now, he also uses a quant and multi-factor model that actually helps people with investing and also uses a lot of gold hedging strategies and risk management strategies as well. So this is going to be a power-packed episode where we learn not only about macroeconomics, quant, technical analysis, fundamental analysis, and we talk about some very bullish sectors in this episode. So don't miss this, stay tuned. And also, if you have not subscribed to the channel, please do so. It'll help us a lot because then I can get more amazing people on this channel to actually give you guys good advice. Let's begin. Hi Manish, how are you? Again, I'm very happy that you're here and you're giving us this time and to the retail audience to give us all your knowledge today. So I'm going to bother you a lot today, right? My first question is, what is IntelliInvest and what made you start this?
Thanks, Shashank. Thanks for having me here. First of all, congratulations on getting the SEBI registration.
Thank you.
I think that's a big milestone. And I think you are going to make a huge impact to this area.
Yeah, hopefully.
Yes. Coming to IntelliInvest. So it's a long story, right? But I think it addresses a few issues really well. Now, if you look at outside, how is this world shaping up? The advisory space shaping up. Now, the intentions might be wrong, which means it is more, is it customer oriented or not? Most of the advice is to increase the number of transactions because the brokerage increases.
Yeah.
And that's probably not in the best interest of the customers.
Yeah.
Right? This is the first space. The second is, do you do active portfolio management or you do passive? So you buy and forget. But we have learned in the past that buying and forgetting, only 1 out of 1,000 work. Rest of them generate a below market return.
And this is contrary to popular belief, right?
Yes.
Because what's been ingrained in us is kharido or bhul jao, buy and forget. And now a lot of people are coming and saying that that doesn't work always.
Yes.
Yeah.
It has stopped working because in the today's world with so much of data outside, there are a lot of strategies going on. So people need to look at short-term profit booking, etc. as well. So active management is the key now. The third aspect is around how do you get emotions out of your decision-making process? So it has to be a data-driven exercise, which we have to do. It combines all the three. IntelliInvest does that. So you get it. It is all data-driven. It is quant strategies. It is a lot of data getting churned, a lot of backtesting being done, and then strategies being created which are useful for clients. And it generates, and it is through active portfolio management. And it doesn't earn anything on the distribution side, no brokerage. It is only on the advisory side. So that it has the interest of the customers at the heart of it.
Very interesting. Now, you mentioned quant strategies, right? So what is quant and what made you get into quant over fundamental or technical?
Okay. So I started investing very early. About 2006 is when I started. So I will tell you the journey and then you will hear how it has become a quant strategy. Because it started off with tips from friends and family, buying small cap. 2006, you remember. 2008, 2/3 of the portfolio is gone. Right? And that was hard-earned money and initial career, right? You know how much more it would have meant. I got away from the market for a couple of years. In 2013, I then started revisiting the market again and saying, should I start investing? But now let me put a little structure around it. So what I did was I leveraged some technical indicators and built a technical strategy, so to say. It's technical, right? It's still a algo-driven thing. So recommendation generation engine, but combining technical indicators like ADX, Bollinger, oscillators, moving averages, but then combining them into one indicator. I think that was the key part to it.
Okay, so just trying to understand. So you took multiple different technical indicators,
Yes.
put some rules to it. That
Yes.
if ADX is above this, if this is
Yes.
above that or below that, then show me some names that fulfill these criteria.
Exactly.
Okay.
So these are buy sell indicators which will come. But then when you have multiple indicators, they have different buys and sells at different time. Then you give weightages to each of these and then say, and what generates me return in the long run, right? So I started investing with that and it worked pretty well. So I stopped making losses. It was year on year profit, all on technical indicators. Towards 2014, I realized that probably I need to incorporate fundamental and sectoral indicators as well. Okay. And macro factors too, because that would give an alpha on top of what I was getting from the technical indicators. And technical indicators usually work in certain scenarios. Whereas if you are a long-term investor, you really need to talk about themes, which themes are going to work for few quarters, years, right? You need to understand those aspects. So I did my executive MBA from IIM Indore, 2 years, with a job and weekend classes, learned all those aspects. Then we put it all together. Now what it became was a fundamental, technical, sectoral, and then on top of it, we created some kind of a market valuation concept. Is the market overvalued? So we call it the bubble indicator. So what is the size of the market bubble right now? And that is, so if you look at it now, it is 65. And now above 75, it gets overvalued. So you should be selling, only selling, no, not buying any replacements. If it goes below 30, you should have all your money into equity.
Got it.
So I think those kind of indicators we built as well. Towards the end of 2022-21, came out with model portfolios. Okay. Now the SEBI regulation was not out at that point in time, but it was being done by a few big names like small cases and all. Saw that they were doing only thematics, mainly thematics, which is like defense sector and all that, right? But then there was nothing like, can it be a wealth solution? Which means, can I manage 1 CR worth of money using a strategy, Quant strategy? That is where we came with the Quant strategies, which had risk management built into it.
Okay.
Which had hedging in place, which had sectoral plays in place. So combining all that, it came out to be a quant strategy.
Wow, very interesting. Now, before we go ahead into more examples, right? I want to understand if you had to talk about some quant models, because I heard that in US, a quant is a very, very big thing right now, right? Earlier, again, it moved from the same way, fundamental to technical, and now it's become quant. In India, first of all, what are the quant models or something that you can talk about that you're using? And do you think it's becoming a very big thing in India now?
Quant is picking up in India for sure. The reason for that being the data availability has become quite good. They're available on APIs, so you can integrate. A result get announced and that is available on APIs and you can just integrate in your, that was not there earlier. And US is ahead of us in that way. And so we are following on the same lines as well. So quant strategy is going to be big. And also I think I talk about active portfolio management and it has to be quant driven. Because if you look at what has done well, I think it is the multi-factor quant strategies which have done well.
Which take multiple. What is multi-factor?
So see, a factor is a driver of returns, right? What that means is momentum. So momentum is a factor which is a driver of returns. Okay. There are multiple factors like these. So it can be momentum, it can be value, it can be you can say. So if you go deeper into fundamentals, you have operational efficiency, you have margins.
Got it. So each of it is a factor.
Yes, and you have performance, you have growth.
Okay.
So these are also there in that. So now you say, how do I mix them? And if you want to mix them, do you give weightages to each? Or you say, let me get heavy on one when one is doing well. You understood? So what then? It is backtesting which helps you. But at the same time, there is one concept around overfitting and underfitting. If you had heard of, it's a data science concept. What people do is they do overfit, which means historically they want to prove it. So they want to generate more and more returns. And what that means is they get heavy on one factor. Correct. And then it doesn't work in the future. So you need to not do overfitting. You should leave it like See, I say it like this. Uh, when you are looking at the returns, if it's a peaked return, right? Do you want that or you want a plateaued return with a higher probability of happening? So when you have clients, right, and they are not as much as a big risk taker as us, let's say we are, right? So for me, I would create a much riskier strategy, which would be momentum heavy. But if you want to give a generic solution, you would rather like to combine and say, I can generate a 30% return with a higher probability, with a probability of 80%.
Yeah.
That is what you would like to say. But as soon as you say 60% return, the probability goes down to 60%. You understand? I think that is where multi-factor comes into play. And you would let it without overfitting. You create a model which works in most of the market conditions.
Do you have some examples where you've used these multi-factor models in the past to get either good results or good companies that have fallen? Can you give us some examples of how this actually works in practice?
Certainly. I will go into a little bit of a history, let's say mid of 2023.
Yeah.
Around that time, we moved from IT sector. It was losing momentum.
2023. Okay. Yes.
Losing momentum. And then capital goods were picking up.
Correct.
We got heavy on capital goods. And it is also just, I'm talking in terms of industry because I cannot talk about factors straight away, right? Which factors were, so you know which factors would have contributed for it to. And then the cycle, and then the defense sector came in.
Okay.
It started having a lot more momentum. Now, once you start doing it, we created an alpha of 10% the first year and 20% the next year.
Oh, this is alpha,
which is above the market.
Above the market.
Okay. And we were able to do it because we were fungible and say we will get out of somebody who loses momentum. We get out of that and picks up the next wave. And it is mostly driven by sectors.
Yeah.
So usually, and I can give some stock examples within sectors. So capital goods, ABB, on the defense sector, HAL, PDL, and all those, right? We know what 24 was that their year.
Huge year.
25 is not. But with all the things which are going around the world, I still feel defense is still undervalued and can have value. And I think it has started picking up momentum as well. So this is how it has helped us generate alpha all along using multi-factor model.
Has it gone the opposite side? I know it looks very nice from one side, but has it ever given you, I mean, obviously everyone has drawdown. Has this model ever given you opposite signs?
So we had a few learnings along the way, right? I would just call it that way. So while the theme was going well, the stock was showing all the things. I can give you example. J Corp, you have heard of that?
Yeah.
What happened with it? It was just one news which killed it, right? Which finished it actually. So they sold it. The land parcel was sold to Reliance in pennies, and the stock prices plummeted from the level, right?
Yeah.
We had that in our portfolio, right?
My God, okay.
And because everything was right, it was no indicators were suggesting it that would happen.
Yeah.
But it happened, right?
Yeah.
So we were able to assimilate those kind of, so these kind of anomalies do exist. And what that we have learned from it is our filtering criteria has to be much sharper, and corporate governance and all other factors needs to be taken into account. So you either concentrate totally on Nifty 100, 200 stocks and build a strategy around it. Maybe you make a lesser return if you were doing it but then the probability is much higher. I think that is how we see it.
Yeah.
Paytm was an example.
Yeah.
So now it's a very regulated space and it's difficult to operate in that space. And Paytm is trying to do something new all the time, right?
Correct.
And it is disrupting the boundaries, and it kind of enters into RBI area or SAB area or something, right?
Yes.
And those, so regulated area, you have to play well as well. So while all of these theme play multi-factor model is there, you have to have some basic filtering criteria around corporate governance, regulatory space, where you should keep away from if you're managing huge sums of money.
Understood. But here I have another question, right? So absolutely correct, because we cannot predict what's going to happen tomorrow. We have our rules and regulations. We buy companies depending on that. And kal kuch bhi ho sakta hai. Market might suddenly go down and something might happen, right? Overnight, something can happen. And this is something I want to ask from a retail audience standpoint, because we own stocks from a long-term equity, mostly from the buy and hold concept theory, right? Now, let's say, for example, recently something happened with Jane Street. A lot of stocks took a beating at that point. Now, from a fundamental or maybe a long-term standpoint, they might be okay and this might be a blip in the future. But at that given point, we don't know ki ye aur girega ki it is at that point. So from you, when you do the strategy, do you wait for a pullback and say, no, this might come back, or do you just say, no, it has violated my rule and I'm out?
Yes.
So how do you do it?
So what we do is, and this is again a learning because the control is finally in human hand. So the model can suggest you an exit or an entry. It is finally we click on the approve button, right?
Yeah.
And the learning has been let the algo do the talking, and when it says exit, it sees something which you haven't seen, which is coming also.
Wow.
So BSC example, and just before Jane Street, we had already exited in most of our portfolios.
Wow.
Because it has peaked out, and it was its valuation had gone above our indicator. It was above 0.9, and we exit any stocks above 0.9
Okay.
valuation. So and this is how it happens. And had I not taken that, we would have been 10% down now, right?
Yes.
So I think those kind of learning has come that let the data drive the returns, and it has worked pretty well.
Okay. Just a very simple, weird question, right? Do you have to be very good in maths to do quant? Because I know it's data driven.
Yeah.
Now, if you tell me start doing quant, I know there is some level of math involved. I have not gone into the technical side. I've gone into the math. But is there math involved in quant?
I would say in the today world of AI, you need to have your concepts clear. AI can do it for you.
Okay.
If you ask ChatGPT, this is the data I have. Can you look at it and tell me which factors contribute to the return? It will run an algorithm for you. It will run a gradient boost algorithm. Now I'm telling you the name. Why I'm telling you the name? Because that is how for a quant for the person, but for a novel, he doesn't need to know, right?
Yeah.
And it will give you the results and say these are the 10 parameters which are important.
Okay.
And are able to define the returns, right? And do you want me to do some next steps? It will ask you.
It will only suggest.
It will only suggest. Do you want to make a model out of it? Something like that. If you understand the domain really well. So I think a lot of people misunderstand that AI is just maths or probably something like that. You need to understand the domain. So which feature set you need to use? Which are the parameters you need to pass? That is, you would know better on the domain side, and let the technical pieces being done by data scientists or somebody, right?
Yeah.
And even an algo, and you can always leverage. I think this is how I would ask as somebody who's just starting can do.
Yeah. So if I'm just starting, is there some books I can read, and then maybe that would help me when I go to GPT as well?
Yeah. So if you
or websites also, anything where I can learn.
Websites or books.
Yeah.
So if you talk just about investing, right? I think we are IntelliInvest. So it has come from Intelligent Investor, and the Benjamin Graham book, The Intelligent Investor, is I would say the Bible.
Even today?
Even today. Not in. So you need to understand the compounding. So the rule of compounding comes from there.
Correct.
First. Second thing, you need to understand the business you are getting into. Then the whole thing around valuation and everything is now data driven. So which he used to do by meeting companies, going to them, talking to the CTO, the CEOs of the company, right? It's not possible at this time. And probably the data would help us do that and get us those things in place, right? So probably that would be a good book to just read, just to understand how history. So you need to understand the history first and where we have reached now, right? There's one book I would recommend, which is How to Read When the Market Speaks.
Okay.
So market gives us a lot of indications about what's going to happen. Are you able to read it well? In this book, when I read it, I found that with Trump in power, a lot of global uncertainty with US in so much of debt, and the dollar can depreciate up to 20-25%. What that would mean for the markets? It's huge.
That's mad.
Yeah. It's a currency which is being used as a reference for all the other currencies, right? And that depreciates to that level. Or he solves his fiscal deficit through these tariffs in some sane form, which doesn't look like to be, right? And it is being done in a very insane way, right?
But he believes so.
He believes so that it is the only sane way to do it. He will also do it very quick. And I think intentions are good. The method might be so questionable. So coming to that book actually talks about hard assets, talks about gold, silver.
Yeah.
Why? Because they say if gold, which is the reference now, it gets depreciated by that, what would hold value?
Oh, that's scary.
And that's the thing. And they're not talking about in another 6 months. They're talking about 4-5 years, 10 years. So they say 2020s entire would be a year of hard assets. But do I change my perspective or change? But I need to keep a good watch of this and probably include it in my multi-factor model. So gold prices can become a part of my multi-factor model, right?
Yeah.
The oil prices, the USD INR rate, all of those factors become part of the model. I think that is what we learn.
Yeah.
And that book is pretty good in that aspect.
So I have one more question to you. This is more from a retail audience standpoint, right? If I'm focusing on value, okay, what are some key factors that a value investor who's a retail audience should look at with an approximate weightage according to you? Like, for example, I would say last 5 years sales growth should be at least, I'm just giving a very big, like, it should be 15% of the weightage, or management should be 20% of the weightage. So if you can give me like few factors with a weightage according to you, which is very important for retail audience to keep in mind.
Now, how do you look at value? So when you said about sales growth is not value. The value would come from price to earning ratio. It is EV to EBITDA margins. So value, how do you look at value, right? So you want to buy something cheaper,
correct,
and sell it at a higher price, right?
And it should be a good company.
Good company, of course. So fundamentally, sound company, it has got good potential.
So wo kya hai
So there are, I would say, 5-6 ratios which stands out. I think I would need my laptop to be able to go to the level of details which our audience needs. Should I?
Wonderful.
So you talked about specifically about value, right?
Yes.
While I had looked at margins, performance, growth, and all those as well, right? If you look at value, right, the price to earning is a very key driver. At times, what happens is earning comes on a quarterly basis, but price moves on a daily basis.
Correct.
What that means is earning is stationary and price is moving. So if the price goes above, you can say the price to earning ratio has gone above the earning. So next earning needs to justify the growth it has already seen.
So the forward earnings is what they call it.
Forward earning, exactly. Forward earning is what they call it. And that is where the shock happens. So stocks which have gone above their price to earning multiples and the result doesn't come good, you see huge correction because they go to the mean again.
Correct.
Right?
Correct.
So if you really want a value, you should start with price to earning.
So this is an example I want to ask if it's correct. So for example, in the past, in 2023-24, when Trent was going all-time high, their PE was at 220 at that point. That means that people are giving a very big premium to the forward earnings.
Yes.
Trent is a fast grower and it will continue growing. But when it was 2024, when it peaked, the earnings slightly disappointed, and that's when the mean reversion started happening. And today it's below 150, I think around 100 and something.
It will go down below more.
Yeah, so that is how you're talking about the concept, right?
Exactly that. And while price to earning is a very important parameter, I think growth number we need to look at it at the same time. So price to earning needs to be justified with the growth number.
Okay.
If the growth is high, it's exponential, then a higher price to earning multiple is justified. So that is what happened with Trent. That is what happened with Zomato.
Yes.
Eternal now.
Yes.
Right? Now the retail is going through a phase where the demand is not increasing and those projections are not working. While it has peaked out in the tier 1 cities, the tier 2, tier 3 is still lagging behind. I think it will be those areas which will then take it back to those levels.
Correct.
So I think you have to combine few things. So value, EV to EBITDA, price to book value, and finally EV to net sales.
So EV is enterprise value.
Enterprise value.
Okay. Enterprise value to earnings before interest, tax,
which is a debt plus equity value.
Correct.
Enterprise value, and net sales, right?
Yes.
So I think these are the 4 or 5 parameters which you really need to create your strategy around if you're creating a strategy around value.
And how do I benchmark this? Like what is good or bad? Is it via the peers or the whole index? How does it work?
Good point. So usually you benchmark it with the industry. And industry will come from the market cap based allocation to all the stocks within that industry.
Okay. Understood.
So you have to give a weight to it.
Understood.
And then you say, what is the industry average looks like?
Correct.
It cannot be a arithmetic sum.
Correct.
You understand? It's a market weighted sum. Market weighted sum. So you have to do that to understand what the benchmark is. And then you compare it with the benchmark.
So an example would be like, I think in hospital space, recently there were a lot of reports that came out from big companies where they benchmarked all the hospitals with EV EBITDA thing. And then they said, I mean, obviously standalone, you cannot say this is undervalued, so buy it. वो नहीं होता है, but it gave a valuation framework of all the companies in that space.
Yes.
Right? Okay.
Yes.
That is how we look at it.
And you have to, so in the banking sector, there are different parameters.
Correct.
non-banking, manufacturing, and there are some categories which are not defined at all.
Okay.
So when Zomato came, what does it? Is it a retail shop? No, it is not. It is a technology. It is
Platform
very
based.
platform play, right?
Yeah.
There's no sector. So it goes into the same sector as Trent. Does it justify?
okay.
You understand? So so those kind of things happen. So you have to. That's why your algorithm needs to have multiple factors so that one of these factors doesn't kill a stock.
Very interesting. Very interesting. And if you had to talk about some sectors,
Yes.
I know you told me that defense is very undervalued, but if you had to give me three sectors for the next 3 years till 2029 election tak, what would you say are good sectors for India?
See, it's a tough one because in our we have exposure to 7-8 sectors.
Yeah.
So I will go in the decreasing order
Okay.
from the top to the bottom. Finance is the key driver.
Finance is too broad. What is finance?
Banks. See, the point is interest rates have come down.
Correct.
Now their main driver is net interest margin and NIM, they call it, right? And probably that is a sector which is gonna stand out because it is going to act as a leading indicator for our growth. They're going to fund all the developments which happens in the infra space. And there's got a lot of infra spending which is going to happen by this government. So 2-3 years when you say it is this government.
So government capex is what they call it, and private capex that they call. This is what is coming, and banks are going to be very key there with the increasing.
Both with the corporate borrowing also. So as soon as interest rates come down, there's a lot of corporate. So a lot of capex is not coming from the private sector because the interest rates were very high. And now the interest rates going down. So finance sector will be the key driver, and it will be followed by infra, capital goods.
Correct.
I think defense because of all the macro conditions we see right now. I think India needs to get to a stage where India can, I would say, win a war overnight.
I think the issue that happened recently, we won it, but the vulnerabilities were exposed, right? So then I think we realized that we need more. We need to do in-house.
So we would go out of stock if it keeps, and if China keeps supplying. So all those things were there, right? So I think that is where the defense sector comes in. So I see a lot of their chemicals. I think chemicals hasn't done well for a long time. I feel that it is undervalued. So there are a lot of good companies in that space.
Correct. And what about pharma? Because pharma is something that the market is talking a lot about with the CDMO theme, right? What do you think about that? Just the space and your
It's a defensive play. See, I always consider pharma as a defensive play. FMCG is a defensive play. In a growth setup, they can save you on bad phases. If we don't spend anywhere else, retail goes down, but pharma will remain where it is. FMCG, normal things we will keep buying. Yeah. So pharma is undervalued. It is because of Trump's fear that he will put some. But if a good trade deal comes out, you will see a good jump in the pharma sector.
Got it. And what are some problems you see for the next 3 years that might come either from a macro side or a micro side? I know you told me that the spending is reduced in tier 2, tier 3. Maybe Trump has again started this whole BRIC nation tariff and all. So what are some problems that you might think might come in the future?
Might come. See, I think I am concerned with the geopolitical situation outside. What it does is, see, India can remain isolated with the global geopolitical situations. We handled Pakistan really well.
Yeah.
Does China have time to do with anything with us? Probably if they have their internal problems, it comes outside, right? I think for them, Taiwan is a bigger problem, right? They would just go and take over Taiwan, and that would create a lot of ruckus as well. So geopolitical creates a lot of turbulence outside. And India, if you look at, and on the software side or whatever we export, if those countries are under problem, they will stop doing all those things. Discretionary spending will go down. So in India, we would say it is the local demand which is going to drive the economy for the next few years till we are out of trouble. So the trouble is still there in the geopolitical situation. So I feel that we have to develop that tier 2, tier 3 cities, demand from there, because as long as we produce and somebody consumes, we will only produce when there is a consumer.
Correct.
Where does the consumption come from? If it is local consumption, better.
Yeah.
And if you look at India as a big 2047, the $20 trillion or the second biggest economy or third biggest economy, right? Or the developed economy as such, right? It will all mainly come from domestic demand.
Got it.
Export, any country which has done so has been driven by domestic, except for China.
Yeah, China is
that's a very different setup. We can't replicate that. We have a very democratic setup, and here the people put the money where they feel there is a return. So startups come in those areas where they see the return.
Yeah, I recently saw someone had said this, that India has not worked on their own LLM for so long because India only puts money where there's profit, and abhi tak LLM mein profit hua nahi hai. So, yeah, this is something very interesting.
Yeah.
But very good point on your thing. I have one more question on the same lines because right now we are spending a lot on green energy and renewable energy in different forms. Do you feel that India is now going to be one of the top players in this space? What is your take on the energy field?
At this moment, if you look at the EV drive which is happening, right? A lot of the rare earth metal sourcing sits with China.
Yeah.
Right. I think it's a very big problem because they control the supply side of things.
Yeah.
It's coming from Africa. They are the one who have put in the plans to take it out and make money out of it. So all these magnets which are getting built, right? All those things comes from there. So EV space is a challenging space for India right now because India is dependent on China. Also, India doesn't have the infrastructure to support it. So, for instance, the charging infrastructure, or probably even if the first source of energy is not green, how can you call a car EV green on the road till the energy which charges that is also green? That's a European concept because they say everything has to be green if it is to be real.
CO2 emission rules and all that.
Right. So it cannot come from a coal powered plant and then run the cars, right? It takes the problem somewhere else. It doesn't solve the problem. CO2 emission, the green energy concept, right? So we have to solve it from the root. So India has a longer journey in this space.
Yeah.
I think the first thing which India needs to do, and I think some of the startups are already started working in this space, is the rare earth space and sourcing raw material and then creating those. But it's a 5 years journey.
Yeah, it's a time.
It's a time critical, and also you need to have that technology also, right? So the technology, some of them have got it at the right time. So the technology is there, but then they need support from government in somewhere, right? Need to happen. I think there is other sources of green energy as well. I think we haven't leveraged the hydro power as yet.
Yeah, what about, I was coming to that, like solar, hydro and wind, which is picking up a lot by some of the big players in India. I think most of the orders are going to all the major players and then it's trickling down to the mid cap, small cap players. So what is your take on that?
I think we need a lot of energy to grow and we need from it everywhere. I think we haven't talked about nuclear. I think small nuclear plants would be a better way of meeting the demands. So these nuclear reactors, small ones, size ones, can be put with data centers.
Correct.
And power the entire data center. We need to get the technology. I think it sits with US.
Yeah, I read a report on that is the next purest form of, the next way to go is nuclear energy, but controlled, contained to do it.
And that's why hard assets are going to be more important.
Wow.
Because uranium is a hard asset. Okay, and talking to this green energy, other areas like wind energy, I think it has a limitation to it. It can be done to a certain extent, but it is being done. If you go around the coastal area from Goa, Mumbai,
the
belt, you will see all those windmills being put in place and everything, right? Yeah. I think it is coming out well. Yeah. I think we have to see. I think that space, we have to see it evolve in India. But there are a lot of areas to improve. I would just say that way.
So demand is there. Supply is being built right now.
Yes.
So that we go away from the traditional sources of thermal, coal and all of that and we go into this. Very, very, very interesting. Okay. I think that was superb, Manish. I think we had a lot of things we spoke about. I hope you guys enjoyed it. But before that, we will go into the rapid fire round, my favorite round. Okay. So I will ask you some questions and you can answer very quickly on this. Okay.
Yes.
So the first question is, according to you, what is the most undervalued theme in India?
Chemicals.
Chemicals is a good theme. Okay. Anything more specific in chemicals, like specialty chemicals,
Specialty chemicals.
Specialty chemicals. Okay. What would you say is your investing style in one word?
Data-driven.
Pure quant. Okay. What is the one website that you use the most?
Investing.com.
Investing.com. We use Screener and all in India. You're using the macro one.
Macro.
What is the one must-read book that all retail investors should do?
There's a Pat Dorsey book on 5 mistakes of investing.
Okay. I think that's wonderful. I'll also start reading this. I have not read this yet. Okay. And the last question is, what is your biggest investing learning? Might have burnt hands also on it, but what is your biggest investing learning? Is
that everybody is a risk taker like me. And I realize that everybody is not. And hence risk management needs to be built into the models.
Okay. So this basically means that everyone wants 100% return, but nobody wants to take the 20% dip. Okay, fine. Okay. That was my rapid fire. Now, one last thing. If you had to tell anything to the retail audience from your side, it can be anything about either investing or one advice that you had to give the current retail audience. Because retail audience usually want to grow as an investor. So what is that one advice you would give as a fund manager to them?
The one advice I would give is start early as possible, and build on it and keep building. I think India is a growth journey. Next 20-25 years is going to shape it like anything. So the more you are invested in it, in different shapes and form. You should diversify a little bit, but then remain invested, I think.
Yeah. And keep learning, I would say, because you mentioned that use AI and start learning
Yes.
more. I think a lot of people are still depending on tips and people like me on YouTube who are talking about companies. Please don't do that. Evolve yourself as well and start learning more is something very good, very good, very good. Thank you. Thank you, Manish. I think that was awesome.
Thanks a lot.
I enjoyed it. I hope you guys enjoyed it as well. And if you guys did, please ask any question you want in the comment section as well. I can ask Manish later and reply to you as well, because the whole process of this is to basically learn as much as possible from amazing fund managers. Right? Thank you, Manish, for everything.
Thank you.
And this is me, Shashank Udupa, signing off.